3 times in the last century, the American economic system broke, not bent, not strained, broke. The first time was 1929. The economy shrank by 29%. 1 in 4 workers lost their jobs. 7,000 banks failed. The stock market lost 80% of its value. It took a decade and a world war to recover. The second time was 2008. The housing market collapsed. Major investment banks disappeared overnight. Unemployment doubled. Trillions in wealth evaporated. Only massive government intervention prevented another depression. Now, in 2025, the warning signs are flashing again. But this time, the conditions are different. Worse, the debt is higher. The vulnerabilities are deeper. The tools that saved us in 2008 have already been used. And multiple crises are converging simultaneously in ways that neither 1929 nor 2008 faced. Recession probabilities from major financial institutions now range from 40 to 93%. Corporate CEOs are bracing for impact. Economic forecasters who've been optimistic for years are suddenly turning cautious. The pattern is unmistakable to anyone paying attention. This isn't about predicting exact dates. This is about recognizing that the ingredients for a crisis worse than 1929 or 2008 are currently assembled. Understanding what made those previous crashes so devastating and why the setup today could produce something even more catastrophic might be the difference between being prepared and being destroyed. To understand why 2025 to 2026 could be worse, you need to grasp just how bad 1929 actually was. The scale of destruction was staggering in ways modern Americans struggle to comprehend. From 1929 to 1933, over 4 years, real gross domestic product fell by approximately 29%, according to Federal Reserve and academic historical data. Imagine the entire economy shrinking by nearly a third, factories closing, businesses disappearing, production collapsing. That's not a recession, that's an economic catastrophe. Unemployment tells an even grimmer story. In 1929, the unemployment rate stood around 4%. By 1933, it had reached 25% of the labor force. 1 in 4 workers had no job. But that figure doesn't capture the full horror. It doesn't count people working part-time when they desperately needed full-time work. It doesn't count those who'd given up looking entirely. Some cities saw unemployment rates above 50%. Cleveland hit 50%. Toledo, Ohio reached 80%. Entire regions became economic wastelands. The banking system collapsed. Between 1930 and 1933, approximately 7,000 banks failed, representing nearly 1/3 of the American banking system. When banks failed in those days, depositors lost everything. No FDIC insurance existed. Life savings disappeared overnight. Families that had been middle class found themselves destitute. The surviving banks stopped lending, strangling any remaining economic activity. Wages for those lucky enough to keep jobs fell 42.5% between 1929 and 1933. Corporate profits dropped from $10 billion in 1929 to $1 billion in 1932. The stock market lost 80% of its value. Prices collapsed in what economists call deflation. Consumer prices fell 25%. Wholesale prices plummeted 32%. This might sound good, lower prices, until you realize it means businesses can't sell products profitably, which means they close, which means unemployment rises, which means fewer people can buy, even at lower prices. A death spiral. What made the Great Depression so devastating wasn't just the initial crash, it was the duration. The economy hit bottom in 1933, but full recovery didn't come until World War II manufacturing ramped up in the early 1942. An entire decade lost, an entire generation scarred. And crucially, there were no safety nets, no unemployment insurance, no social security, no welfare programs, no FDIC guaranteeing bank deposits. When you lost your job or your savings, you were on your own. That vulnerability amplified every aspect of the crisis. Jump forward to 2008, and the Great Recession looks almost mild by comparison. Almost. Real GDP fell just 4.3% from peak to trough according to Federal Reserve data. That's still the worst decline since World War II, but it's nowhere near the 29% collapse of the 1930 seconds. The recession lasted 18 months, from December 2007 to June 2009. Bad, but not a decade of depression. Unemployment peaked at 10% in October 2009, roughly double the pre-crisis rate. Again, severe but nowhere close to the 25% of 1,933. About 8.7 million jobs were lost. Housing prices fell approximately 30% on average from their mid-2006 peak to mid-2009. The S&P 500 stock index fell 57% from its October 2007 peak to its trough in March 2009. Household wealth dropped from approximately $69 trillion in 2007 to $55 trillion in 2009. These numbers represent real suffering. Millions lost homes to foreclosure. Families were destroyed. Retirement savings evaporated. The economic and psychological scars lasted years. But compared to 1,929, the 2008 crisis was contained. Why? Swift, massive intervention. The Federal Reserve dropped interest rates from 5.25% in September 2007 to essentially zero by December 2008. They implemented quantitative easing, creating trillions in new money to buy mortgage-backed securities and treasury bonds. The federal government passed TARP, the Troubled Asset Relief Program, injecting $700 billion directly into the financial system. Then came the American Recovery and Reinvestment Act, nearly $800 billion in fiscal stimulus. The infrastructure created after 1929 to prevent another depression worked. FDIC insurance meant depositors didn't lose savings when banks failed, preventing bank runs. Unemployment insurance and Social Security provided basic support, preventing total destitution. Automatic stabilizers like progressive taxation meant government revenue fell and spending rose automatically during downturns, providing stimulus. These mechanisms, plus aggressive Fed and fiscal action, prevented 2008 from becoming 1,929. But that raises an uncomfortable question. If similar conditions emerge in 2025 to 2026, can the same playbook work again? Or have we exhausted the tools while creating vulnerabilities that make the next crisis worse than anything we've seen? As of late 2025, recession probabilities from major institutions are elevated in ways that should concern everyone paying attention. JP Morgan initially projected a 60% probability of recession by end of 2025, later revised to 40%. Bankrate's Economic Indicator Survey shows economists assessing a 39% chance of recession by September 2026, up from 35% the previous quarter and 26% at end of 2024. In one striking moment in September 2025, UBS's recession model briefly calculated a 93% probability based on economic indicators, including personal income, consumption, industrial production, and employment. Corporate chief financial officers, the people actually running businesses and seeing real-time data, paint an even grimmer picture. The CNBC CFO Council survey in March 2025 found that 60% of CFOs expected recession in the second half of 2025, with another 15% expecting it in 2026. 95% said policy uncertainty was impacting their business decision-making ability. UCLA Anderson School of Management activated formal recession watch status in March 2025, citing multiple simultaneous risks converging. These aren't conspiracy theorists or perma-bears. These are mainstream financial institutions and corporate leaders who typically err on the side of optimism. When this many independent analyses point in the same direction, the probability of crisis rises substantially. But probabilities alone don't explain why 2025 to 2026 could be worse than previous crashes. The answer lies in the specific vulnerabilities that have accumulated. First, debt levels dwarf anything seen in 1929 or even 2008. Total U.S. household debt exceeds $17 trillion as of 2024, according to Federal Reserve data, with mortgage debt near $12 trillion, auto loans approximately $1.6 trillion, and credit card debt approaching $1.1 trillion. Corporate debt has reached record levels relative to GDP. The federal government carries debt exceeding $36 trillion and rising by about $1 trillion every 3 to 4 months. In 1929, government debt was manageable. Private debt was elevated, but nothing like current levels. In 2008, debt was high but addressable through policy interventions and a decade of deleveraging. In 2025, we've taken on far more debt. While the economy has grown more slowly, the debt-to-GDP ratio has deteriorated dramatically. This matters because debt constrains options. Highly indebted households can't withstand job losses or income shocks. Heavily leveraged corporations face bankruptcy if revenues decline. Governments drowning in debt struggle to implement fiscal stimulus without triggering bond market crises. Second, multiple simultaneous shocks are converging in ways neither 1929 nor 2008 faced. The 1929 crash was primarily financial and domestic, spreading internationally through the gold standard. The 2008 crisis was primarily housing and financial. But 2025 combines trade wars, approaching Smoot-Hawley tariff levels from the 1930 seconds, elevated geopolitical tensions, threatening global stability, persistent inflation, unlike either previous crisis, and financial asset valuations that, according to UCLA Anderson analysis, parallel the dot-com bubble at levels that historically precede major corrections. Trade policy specifically creates risks that compound other vulnerabilities. Research from UCLA Anderson notes that if fully implemented, the effective U.S. tariff rate could rise to levels similar to the Smoot-Hawley tariffs during the Great Depression, which are widely believed to have worsened that crisis substantially. Tariffs simultaneously raise consumer prices, which feeds inflation, while damaging corporate profitability and reducing economic growth. This creates the nightmare scenario economists call stagflation, where you get both high inflation and economic stagnation or recession. Third, policy tools have been largely exhausted. In 1929, policymakers had never tried aggressive monetary stimulus. They made mistakes, but the tools existed unused. In 2008, the Fed could drop rates from over 5% to zero and implement unprecedented quantitative easing. Fiscal stimulus, while politically contentious, was economically feasible given lower debt levels. But in 2025, interest rates spent years near zero and were only recently raised to combat inflation. Quantitative easing was already deployed on a massive scale, expanding Fed balance sheets by trillions. Another round might work, but with diminishing returns and greater risk of inflation or currency devaluation, fiscal stimulus faces even harder constraints. Government debt has reached levels where additional borrowing risks triggering bond market concerns about sustainability. The political environment is more dysfunctional, making swift crisis response legislation difficult. And, crucially, there's political pressure on Federal Reserve independence, with proposals to give elected officials more control over monetary policy, which historically leads to poor decisions driven by short-term political considerations rather than economic necessity. Fourth, new systemic risks have emerged that didn't exist in previous crises. Private credit markets have become a significant shadow banking sector, with systemic risks that, according to UCLA Anderson, are not well understood and likely underappreciated. These markets operate outside traditional banking regulation, creating leverage and interconnections that could amplify shocks in unpredictable ways. Cryptocurrency and digital asset exposures add another layer of unknown risk. The scale and speed of modern financial markets mean that crises can propagate globally in hours rather than days or weeks. Fifth, financial asset valuations suggest a dangerous disconnect from reality. UCLA Anderson's analysis notes that even with the current sell-off, equity valuations are at levels that parallel the dot-com bubble. Corporate bond spreads are near all-time lows, suggesting investors aren't adequately pricing risk. House prices are near record levels, while unsold home inventory has reached levels last seen in 2009 during the depths of the housing crash. This combination of elevated prices and rising supply typically precedes significant corrections. The stagflation risk deserves special attention because it represents a scenario neither 1929 nor 2008 faced. The Great Depression was deflationary. Prices fell, which sounds good but creates economic death spirals. The 2008 crisis saw inflation remain relatively contained, allowing aggressive monetary easing without triggering price spikes. But 2025 combines slowing growth with persistent inflation. What Bank of America economists have specifically warned represents the true risk to the economy. Stagflation is policymakers' nightmare. If the economy weakens but inflation remains elevated, what do? Cut rates to stimulate growth, and you risk accelerating inflation. Raise rates or hold them steady to combat inflation, and you deepen the recession. There's no good option. This is exactly the trap the Federal Reserve found itself in during the 1970 seconds stagflation, and it took brutal interest rate hikes that triggered severe recessions to break inflation's back. Bank of America economist Aditya Bave predicts the Fed won't cut interest rates until 2026, specifically because cutting rates in a stagflationary environment without clear evidence that inflation has peaked is too dangerous. The employment data through mid-2025 shows concerning deterioration. The U.S. economy added just 73,000 jobs in July 2025, far below the typical pace of around 200,000 monthly needed to keep unemployment stable. The Bureau of Labor Statistics revised May and June estimates sharply lower, reducing them by a combined 258,000 jobs compared to previous estimates. The unemployment rate ticked up to 4.2% from lower levels earlier in the year. DataTrek research notes that there can be single months with negative job growth during expansions, but when job growth starts meandering around the zero level, it's a warning sign of looming recession. By September 2026, economists surveyed by Bankrate expect unemployment to climb to 4.6%, and job growth to average just 49,000 jobs monthly, less than half the current pace. That's not collapse, but it's nowhere near a healthy labor market. Consumer confidence hit a 12-year low, according to recent readings. 90% of CFOs surveyed said tariffs will cause resurgent inflation. Half of CFOs now believe the Fed won't achieve its 2% inflation target until late 2026 or 2027. Corporate behavior reveals what executives really think versus what they say publicly. The number of CFOs planning to increase capital expenditure in 2025 declined roughly 10% from the fourth quarter of 2024, according to CNBC surveys. When businesses cut planned investment, it signals expectations of weaker demand ahead. Industrial production slipped 0.1% in July 2025, according to Federal Reserve data, another warning indicator. The global dimension amplifies every domestic vulnerability. A crisis beginning in 2025 to 2026 would propagate through a more interconnected world than existed in 1929 or even 2008. Supply chains are integrated across dozens of countries. Digital financial systems move money globally at light speed. Currency movements affect every nation simultaneously. There are fewer safe havens. In 1929, much of Asia and Africa were colonized, insulated from immediate contagion. In 2008, emerging markets could partly offset developed world weakness. But in 2025, slowdowns in the US, China, and Europe simultaneously would drag down the entire global economy. What could trigger the actual crisis? History teaches that highly leveraged, overvalued systems don't need spectacular triggers. Sometimes a small shock exposes underlying fragility. Potential catalysts include a debt ceiling crisis that shakes confidence in U.S. creditworthiness, failure of a major bank or financial institution revealing hidden systemic weaknesses, geopolitical shocks, disrupting energy or supply chains, Federal Reserve policy mistakes either cutting rates too slowly and deepening recession, or cutting too quickly and reigniting inflation, or trade war escalation that tips already fragile corporate sectors into contraction. The pattern across three crises is clear. Each time, debt levels were higher. Each time, asset valuations were more stretched. Each time, the system was more complex and interconnected. What saved us in 2008, aggressive policy intervention, may not be available or effective in 2025 to 2026, given current debt levels, exhausted policy tools, political dysfunction, and stagflation risks. The safety nets created after 1929 remain, but they're strained by the scale of potential losses if asset prices and debt levels both adjust sharply. None of this guarantees a 2025 to 2026 crash will be worse than 1929 or 2008. Recessions aren't inevitable. Policymakers might thread the needle, managing trade negotiations, bringing inflation down without crashing growth, and avoiding triggers that spark panic. Probability isn't certainty. A 40% recession probability means 60% chance of avoiding one. But 40% odds of economic catastrophe should terrify anyone paying attention. What makes current conditions particularly dangerous is the combination of factors. High debt plus elevated asset prices plus policy exhaustion plus multiple simultaneous shocks plus stagflation risk plus systemic unknowns equals a powder keg. Any one of these might be manageable. Altogether, they create fragility that exceeds 1929 or 2008. We have more knowledge than previous generations about how crises develop. We have better institutions and safety nets. But we also have far more debt, more complex financial systems, more geopolitical tensions, and less policy flexibility. The warning signs are flashing. Recession probabilities elevated. Corporate leaders bracing. Employment weakening. Confidence falling. Asset valuations stretched. Debt at records. Multiple institutions that typically maintain optimism are sounding alarms. This doesn't mean panic. It means preparation. Understanding that the ingredients for crisis worse than 1929 or 2008 are assembled helps you make decisions that protect yourself and your family when things break. History doesn't repeat exactly, but the pattern is clear. Excessive debt plus elevated asset prices plus policy mistakes eventually force painful adjustments. Those adjustments can be gradual and managed, or sudden and catastrophic. The conditions in 2025 suggest we're closer to sudden and catastrophic than at any time since 2008, with vulnerabilities that exceed even that crisis. If this gave you a new perspective on the risks building in the current economy and why 2025 to 2026 could be worse than previous crashes, hit that subscribe button. Understanding the pattern, seeing the warning signs, and preparing for what history suggests is coming might be the most important financial education you can get. The crashes change their timing, but they never change their character. And right now, the character looks ominous.